One of my favorite ways to find investing ideas: stealing from super investors. Super investors are investors with over 100 million in assets under management, and every quarter they are required by law to reveal all of the moves they've been making in their portfolio. And I recently compiled the data to make a list of the top 50 most frequently bought dividend stocks by super investors in the most recent quarter, and you can actually download this sheet for free in the description. So in this video, we're going to be reviewing the top 10 most bought dividend stocks by super investors, so let's go ahead and dig in. Now, there can be a lot of value in simply looking at the different buys that super investors have been making, but at times there can be even more value in looking at the underlying trends when you conglomerate the data. So that's exactly what I did, and one of the things we can see is, like always, super investors have a bias towards high quality dividend growth stocks. These are stocks with low payout ratios that grow their dividend payments at a high rate and typically have above average levels of return on invested capital. But when we take a closer look at the actual sector breakdown of the stocks that they bought, we notice an interesting trend. Now, buying a lot of technology stocks and financial services stock is pretty common for these super investors. They love to buy high quality stocks like Microsoft or Visa or MasterCard. But in this most recent quarter, we noticed something out of the ordinary, and this actually happened last quarter as well. The most frequently bought sector was healthcare, coming in at 9 different stocks. Now, this is interesting for a few different reasons. To start off, if we jump over to Seeking Alpha, link in the description, but we're looking at the Vanguard Healthcare Index Fund ETF shares, and over the last year, it's down by about 6.63%. Compare this to the S&P 500, which is up around 10% in the last year. That's interesting, but it gets even more interesting when we actually look at the valuations of healthcare sector stocks versus the general S&P 500. For example, look at the S&P 500 healthcare sector forward PE ratio. It has come down dramatically over the last year, and right now it's sitting at about 16.91. If we zoom in just a little bit more, you can see over the last 5 years, that's pretty much the lowest that it's been. Compare this to the S&P 500, and if we look at that PE ratio, it's pretty much the highest it's ever been. So not only has the performance been quite different, but the actual valuation of the S&P 500 versus healthcare sector S&P 500 stocks is dramatically different. Now, what situations do investors typically gravitate towards healthcare stocks? It's when there's uncertainty in the market, when there is a looming recession potential. So I've never really been in the game of trying to predict what's actually going to happen to the economy in general, but it is interesting to see that super investors are ramping up their purchases of healthcare stocks. Now let's go ahead and jump over to our top 10 lists, and you can see many of the stocks are already filled out. We have companies like Google, Capital One Financial, Lennar Corporation, Wesco International, Taiwan Semiconductor, and Meta Platforms. But there's 4 stocks on this list that I want to take a closer look at because they're interesting for a few different reasons. And the first stock on this list is actually going to be Dollar General, a stock I don't think many people would have expected to be on this list. Now, Dollar General is actually a stock I was frequently talking about over on Dividendology.com over the last few months and discussed how it appeared it was dramatically undervalued. And what's interesting is if we look at Dollar General's performance over the last year, it's down about 10 to 11%. But look at the bounce back it has seen year to date. It's up almost 50% in 2025. That is absolutely mind-blowing. So what's been going on with this company? Now, again, if we zoom out, we can see the company saw a major sell-off in the summer of 2024, dropping from about $125 per share all the way down to about $82 per share, and the sell-off continued, going all the way down to around $66, $67 per share at the beginning of 2025, and that's when things turned around. So what's going on? Has the company been able to turn things around financially speaking? Well, let's go ahead and jump over to our stock screener. Come up here and plug in the Dollar General ticker. And we can see all this data will automatically load in. And like always, if you'd like to download any of these spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, when we look at Dollar General, what we can see is, yes, revenue per share over the past decade has been steadily increasing, but that has not been the case when we look at earnings. 2020 earnings got up to $10.70, and it remained pretty high for a couple of years. And then we saw a pretty dramatic fall. 2023 down to $7.57. 2024, $5.12, and the same was true with free cash flow. Now, on top of this, we will point out the company's been buying back a lot of their outstanding shares, but look at how bad return on invested capital has been over the last couple of years. 2023, just 7.3%. 2024, only 5%. And we have to remember, whenever a stock has a return on invested capital below their weighted average cost of capital, they're actually destroying shareholder value by reinvesting back into the business. And for most stocks, that weighted average cost of capital is typically somewhere between 6 to 9%. So for example, 2024, disastrous year for this company. So why has the stock climbed so much in 2025? Well, I think it's a combination of a couple of different things. To start off, we have to remember the stock was already dramatically oversold. But if we look at the most recent earnings report, the market reacted very positively. To start off, we can see they updated their 2025 EPS outlook to about $5.20 to $5.80 while accelerating story models and digital growth. So they boosted their EPS projections. That's always a very good sign. And for reference, at $5.20 to $5.80, if we jump back over to that stock screener, we can see that would put them a decent bit higher than where they were in 2024. So the trend of going down is coming to an end. They're back on the up and up. On top of this, if we scroll down, we can see another positive sign. Gross profit as a percentage of sales was 31%, an increase of 78 basis points. So let's take a closer look at that. If we jump over to the profitability sheet, I've already plugged in Dollar General. What we can see when it comes to their gross profit ratio is their 10-year average is about 30.8, but last year's came in at 29.59%. So the gross profit ratio was a little bit lower than their 10-year average. But again, what happened in this most recent quarter? Well, if we zoom in, let's come down and take a closer look. If we use the ticker data function, we can easily pull in the quarterly gross profit ratio. We use the ticker data function, select Dollar General, select gross profit ratio 2025, and then select Q1 and hit enter. And we can see last year's gross profit ratio again came in right at 31%, which was a nice boost up compared to last year's gross profit ratio as a whole. So another bright spot for the company. Now, if we look at them from a dividend perspective, it's actually quite interesting. What we can see is that starting dividend yield sitting at about 2%, with the 10-year dividend CAGR sitting at above 10% in the 5-year, above 11%. So a good track record of dividend growth. But look at this in 2022 and 2023. Free cash flow did not do a good job of covering those dividends, which is a major red flag, but things turned around in 2024 when they had a free cash flow payout ratio of just 30.78%. Now, if we look at the yearly dividend payout history, it looks kind of odd, but that's really due to the timing of those dividend payouts. If we just look at them on a quarterly basis down here, what we can see is this company's been paying out 59 cents per share for about 3 years in a row now. So they haven't been increasing those dividend payments, which again, not technically a good sign, but the company was struggling pretty heavily in 2022 and 2023. So it's easy to see why that was the case. So the question we have to ask, is it too late to buy Dollar General? Again, we have to remember these buys from super investors were during the first 3 months of 2025. So if we look at just the last few months, they're buying Dollar General pretty much in this range right here. And the stock has gone up dramatically since then. So what type of returns could we expect if we buy Dollar General at its current prices? Well, we can actually jump over to my sensitivity analysis with ticker data and take a closer look at that. Again, our future total returns are a combination of two things: the company's future PE ratio and the projected EPS growth rate. Now, that doesn't include dividends, but we can touch on that here in a moment. Now, what's cool about ticker data is if we come down here and zoom in, we can see we can automatically import into our spreadsheet the average analyst earnings per share estimate. So we have multiple estimates from analysts, and we're taking the average estimate for each year. And what we can see is through the year 2029, we're getting a projected EPS CAGR of about 10%, which in my opinion might be a little bit on the high end for Dollar General's projection, but let's just go with the average analyst estimate. So we'll go with 10% for the projected EPS growth rate. Now we need our projected PE ratio, and we can see historically speaking over the last decade, the average PE ratio is about 18.65, but for the trailing 12 months, it's 21.59, which is about 15 to 16% higher than it has been historically speaking. So let's say the future PE ratio for the stock is around 19. If we scroll down, all of a sudden we can see by the year 2030, our total return would be about 55%, which would be a compounded annual return of 7.63%. So that's pretty close to the market average historically speaking. So obviously there's still some upside, but it looks like the majority of the opportunity was really when the stock was trading in that low $70 range. Again, check out dividendology.com. I did point this out earlier. Now, the 6th most frequently bought stock on this list is going to be one of the most unique situations that we're going to be looking at, and that's Texas Instruments Incorporated, a stock that I actually own in my personal portfolio. And if we look at the stock over the last 5 years, we can see it's up around 58%, but if we look at this trading period from around 2021 to present day, the stock is virtually flat. Now, if we look at the past decade, it's way outperformed the market, but in the last year, up about 2.22%. Now, it's extremely important we understand what's actually going on with this company. So before we actually dive into the investor's presentation, I want to jump over to the dividend breakdown sheet. Let's go ahead and zoom out and come up here and plug in Texas Instruments. Now, what we can see is the company has a history of growing dividends at a high rate, with the 10-year dividend CAGR at 14% and the starting dividend yield right now at about 2.7%. But look at that earnings payout ratio, nearly 100%. Free cash flow payout ratio, 320%. So what is going on with this company? Well, look at what happened from 2022 to 23 and 24. Free cash flow fell off a cliff. We can see in 2022, free cash flow was nearly $6 billion. In 2023, down to $1.3 billion. In 2024, around $1.5 billion. Now, obviously, that is a major red flag. So what's going on? And what we're going to see is why it's so important we actually understand the story behind the numbers, understand what's actually going on with the business. So let's take a step back here for a moment. If we jump over to the Investors Relations page for Texas Instruments, we get a quote from the chairman of the board, Rich Templeton, and he states the best measure to judge a company's performance over time is growth of free cash flow per share, and we believe that's what drives long-term value for our owners. And I couldn't agree more. The reason I focus on free cash flow so much is because we have to remember, a management team has 5 options with free cash flow. They can reinvest back into the business, attempt mergers and acquisitions, pay down debt, buy back shares, or pay out dividends. So really the ability to reward shareholders strictly comes from free cash flow, and even the ability to pay out growing dividends comes from free cash flow. So I love to see that management team is clear and focused on growing free cash flow. Now, here's what's interesting. If we look at their recent investors presentation just a few months ago, here's what they state. Our capital allocation approach, talking about how they're using free cash flow, remains focused on supporting the opportunity ahead. We are nearly 70% through a 6-year elevated CapEx cycle that, when completed, will uniquely position Texas Instruments to deliver dependable, low-cost 300 nm capacity at scale to meet customers' demands, scalability of CapEx, including capacity modularity, free cash flow per share growth across a range of market conditions. Okay, that was a mouthful. What do they mean by this? Well, basically what's been happening with Texas Instruments over the last few years is they have heavily ramped up their research and development and capital expenditures to around $5 billion per year, which is about triple to their prior levels of capital expenditures. Now, the reason they're doing this is to meet future demand and secure production control. So again, the end goal is to maximize long-term growth of free cash flow per share. So if we scroll way down in this presentation, we can see some of the benefits of this. To start, it's supporting their growth. It's giving them control over their supply, optimal technology, and structural cost advantage. And this one is huge. Look at this. They believe that because they've ramped up capital expenditures, their chip costs in the future will be about 40% less. And this will significantly increase their gross margins. So for example, right now, if we go ahead and jump over to the profitability sheet, let's look at Texas Instruments. We can see the gross profit ratio has declined a little bit over the last couple of years, with last year coming in at about 58%, but this is projected to significantly increase in the coming years because of these investments they've been making over the last few years. And so near the end of their investors presentation, they talk about delivering free cash flow per share growth. And again, historically speaking, they've done this very well. In fact, let's jump back over to the stock screener real quick and look at Texas Instruments. And we can see from 2014 to around 2021, we saw significant growth, and then of course the drop off in 2023 and 2024. But look at what management team is projecting starting in around 2026. We went through this period of elevated capital expenditures, and as a result, they're expecting the free cash flow trend to get right back on track starting in 2026, with free cash flow per share coming in at the low end of about $8 to $9 and on the high end around $11 to $12, which either way, that would still put them up significantly more from where they were in 2022. And so while Texas Instruments has certainly been stalling out over the last few years, at least when it comes to their share price appreciation, and while free cash flow per share has actually gone lower over the last few years, it doesn't tell the whole story. And so the fact we're seeing super investors buying this stock tells me one thing. They expect these capital expenditures to pay off quite well over the next few years. This is a stock I own in my portfolio, and I'm excited to continue to hold it. Coming in at number 4 is actually one of the more controversial stocks in the market today, and that's going to be Google stock. Now, this is controversial for one main reason. Is Google's moat being eroded? Are they losing their search engine dominance? Is AI going to take massive market share? Now, when we look at Google over the last year, they're pretty much traded flat. And if we look at them year to date, they're down about 6.62%. And what's interesting about this is that forward price to earnings multiple is currently sitting at about 18.2, which is lower than the average stock in the S&P 500, despite the fact Google's been growing their earnings at a pretty rapid rate over the last decade. If we jump over to the stock screener and look at Google, and you can see exactly what I'm talking about. 2014 earnings at just $1.07. 2024, $8.04. So, we're talking about explosive growth over the past decade, but overall, the share price really hasn't grown at the same rate as earnings, despite it going up about 500% in the past decade. So again, the question remains, is Google earnings growth going to slow down dramatically due to the threat of AI? Now, there's a couple of things we have to consider when we ask ourselves that question. Google recently released their Q1 2025 earnings report, and everyone wanted to know exactly what was going to happen to Google search revenue. And over here, here's what we can see. Google search revenue in the dark red grew by 10% year over year. So revenue grew at a double-digit rate. And this was a great sign for the stock, and it caused the stock to rally quite a bit on the release of earnings. So this was a good sign, basically saying AI isn't really slowing down the earnings growth yet. And then we also have to remember, Google is a major player in the AI race, and a lot of people haven't accepted this yet. But look at how Google's Gemini shapes up to some of these other AI models. We can see Gemini 2.5 Pro, when it comes to best in reasoning, is number one. If we scroll down, if we look at best in adaptive reasoning, again, Gemini 2.5 is number one. And if we look at best overall, Gemini 2.5 Pro is number one overall. We have to acknowledge Google is becoming a major player in the AI race. That doesn't necessarily mean they're going to win the end game when it comes to AI, but it certainly means we can't just write them off. Now, on top of this, when we talk about Google, we have to take a moment to actually talk about the valuation. If we jump over to my stock valuation sheet and plug in Google, here's what we want to pay attention to. Look at the historical multiple valuation model for Google. If we zoom in, what we can see is basically how the market has been valuing Google over the past decade. And in fact, let's go ahead and remove this huge outlier we have in 2017. As an end result, we can see the average PE ratio for Google over the last decade is sitting at about 25.86. That's the average PE ratio over the last decade. For the trailing 12 months, it's sitting at just 19.4, which is about 25% lower than the historic average. So compared to that historic multiple, Google is 25% cheaper. And keep in mind, if we look at the forward PE ratio based on forward earnings, that PE ratio is only 18.2. So again, Google is dramatically undervalued compared to that historical multiple valuation. But let's go ahead and look at that sensitivity analysis. We'll come up here and plug in Google stock to see what type of returns we can expect based on a few different variables. Now again, that first variable we have to apply is our future PE ratio. Again, let's remove the outlier in 2017, and the average PE ratio over the last decade is around 26. For the trailing 12 months, just 19.4. So let's be conservative with projections like I typically prefer to be. Let's assume the PE ratio in the future is only around 21, so it doesn't even revert back to the average over the past decade. Now we need to project our future earnings growth. Again, one of the cool features with ticker data is you can automatically import the estimated average EPS projection from analysts over the next few years. And here's what we can see are the EPS projections for Google through the year 2029. Based on that 2029 earnings per share, we have an EPS CAGR of 14.36%. So the overall consensus is Google's still going to be growing earnings at a pretty high rate moving forward. So again, let's be a little more conservative with our projections and just go with 12%. As an end result of this, we can see by 2030, our total return would be about 100%, leading to a compounded annual return of above 12%, which obviously way outperforms the market average. And this is with conservative estimates. If we just go with that average analyst estimate of about 14.36 and still just assume that the PE ratio recovers a little bit more, but not even back to that 10-year average, all of a sudden our returns look quite attractive by the year 2030. 142% return with a compounded annual return of nearly 16%. So I'm not at all surprised to see Google made this list, and keep in mind it's actually on here twice because we have the GOOG ticker and the GOOGL ticker. I frequently get asked what's the difference, and essentially it's basically just voting rights. And then finally, we have what is one of the largest positions in my personal portfolio, and that is going to be Microsoft Corporation, stock ticker MSFT. And if we look at this stock, it's trading right at its all-time high, only up about 7% in the last year, but year to date up about 13 to 14%, and really just in the last month, it's seen pretty decent returns, up about 6.24%, pretty solid for the past 1 month. Now, here's what's so interesting about Microsoft. Again, they were the most frequently bought dividend stock by super investors in the most recent quarter, but I've been tracking this every single quarter for years. So let's go back to Q4 of 2024 and look. We can see again, in Q4 of 2024, Microsoft was the most frequently bought dividend stock. Let's go back again, Q3 of 2024, Microsoft was the most frequently bought dividend stock. And if we go back to just 1 year ago, Q2 of 2024, Microsoft was the second most frequently bought dividend stock. So super investors, actually like myself, absolutely love Microsoft. Now, what is there to like about Microsoft? Well, let's just look at them from a fundamental standpoint to start. I'll plug in Microsoft, and here's what we can see. Pretty much everything we look at looks quite attractive. Revenue per share has grown at a high rate over the past decade. The same is true with earnings per share. The same is true with free cash flow per share. If we look at the debt to assets ratio, they're becoming less leveraged. It's looking healthier and healthier, but it wasn't even in a bad spot to start with. And then return on invested capital, one of the key indicators of a high quality company. How profitable are the projects the company is investing their capital into? And we can see for Microsoft, it's been above 20% now for 4 consecutive years. So as a baseline, we typically want to see around 10%. When you get to 20%, we're talking about a high quality company. If we look at the profitability sheet, again, take a look at Microsoft. One of the other indicators of a high quality company is not just a solid gross profit ratio, but an increasing gross profit ratio. And the average gross profit ratio for Microsoft over the past decade is about 67%, which is very solid. But last year it came in at 69.76%. So they're already very profitable, but they're becoming even more efficient. Even as revenues climb, the costs aren't growing at as high of a rate, leading to more dollars on the bottom line. I absolutely love that. If we look at the stock from a dividend perspective, yes, the yield is low. That's what you would expect out of a stock that's grown at a really high rate, but they're growing the dividend at a healthy rate, close to about 10%, and that dividend growth is backed by free cash flow growth. Here's what I love about the stock. If we look at that free cash flow payout ratio over the past decade, it's actually been declining. So even though they're growing the dividend at a high rate, the free cash flow payout ratio is going down because free cash flow is growing at a faster rate than the dividend. So hypothetically speaking, they could be growing the dividend at an even faster rate if they chose to do so, and the stock could easily remain just as healthy. Now, when we talk about the actual business model for Microsoft, again, let's go ahead and look at their most recent earnings report. We can see the 3 different business segments: productivity and business processes, intelligent cloud, and more personal computing. And they're seeing great growth out of each of these business segments. Now, similar to Texas Instruments, Microsoft is also going through a period of higher than expected capital expenditures, but this is completely planned out. They're stating this is to support our cloud and AI offerings. So free cash flow over the next year or so might be a little bit lower, but we won't see a dramatic drop off. But again, don't fret, this is completely to be expected to support future AI offerings. Again, Microsoft is always looking to remain a leader in their sector. But after that, one of my absolute favorite things about Microsoft, if we jump all the way to the end of this presentation, look at all their different business offerings. Microsoft is essentially its very own tech ETF with all their different business offerings, and on top of this, look at the growth rates that they're seeing out of these different business segments. Everywhere I look, I'm pretty much seeing double-digit growth, and in some areas, growth of around 33%, 22%, 20%, 34%. Microsoft is a very diversified business, and most of those business segments are growing at a very high rate. Now, let's take a moment to talk about the valuation. And I want to point out, like we've already talked about, Microsoft is a high-quality company, very profitable, high levels of return on invested capital. And in fact, if we jump over to the free cash flow analysis sheet, something else I do want to point out is if we come over here and look at the free cash flow margins for the stock, what that is basically telling us for every dollar of revenue the company generates, how much is actually becoming free cash flow. we can see it's actually quite efficient. So again, all the signs of a high quality stock. And as a result, this is going to be a stock that typically trades at a premium. For example, if we go ahead and jump over to my stock valuation sheet and plug in Microsoft. Again, thanks to ticker data, all the data will load in, but to start, let's just look at that historical PE ratio valuation. Again, what we can see is on average over the last decade, the average PE ratio is about 31.1, but on a trailing 12 months basis, it's currently sitting at about 36.86. So the stock is trading at about an 18.5% premium to its historical PE ratio. Now, if we look at that PE ratio on a forward-looking basis, it's just a little bit lower, sitting at about 35.45. But let's go ahead and look at this stock from a dividend discount model perspective. Assuming the stock grows a dividend at about 8.25% in the future, we can see we'd actually come to a dividend discount model price per share of $467.64, which is only about 2% off from that current share price. So yes, Microsoft does appear to be trading at a bit of a premium, but I mean, this is one of the highest quality companies out there. And again, I do want to point out, the buys that super investors made were made during Q1 of 2025. So if we look at the last few months, keep in mind, they were actually bought at a lower price, potentially as low as around $380 per share. But again, this is why it's important to have these stocks on your watch list, to know what your buy range is, because there's certainly been opportunities to buy Microsoft at great valuations in the last few months, and that's exactly what I did. And of course, if you want to keep up with my personal purchases for my portfolio, then you can check them out over on Dividendology.com. So there you go, these were the top 10 most frequently bought dividend stocks by super investors in Q1 of 2025. Again, I've created a full report of the top 50 most frequently bought dividend stocks that you can get for free at the link in the description. So go ahead and let me know what you think of these stocks in the comments down below. And like always, if you'd like to download any of these automated spreadsheets and get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.